What's going on, everybody? JT here, and I have a fantastic guest for you. We have Jerry Chu, who is the CEO and co-founder of Lofty AI. Now, Lofty AI is a real estate technology company built on Algorand that uses artificial intelligence to predict neighborhood growths around the world. Lofty AI has been featured on Forbes, Business Insider, Yahoo Finance, and more, and have already tokenized over $24 million worth of real estate. Super excited to have this conversation. So without further ado, welcome to the show, Jerry. How you doing?
I'm doing well. Thanks for having me on, JT.
Absolutely. I appreciate you taking the time out of your day to join us.
Happy to be here.
Awesome. How about we start off maybe with a quick background on yourself and how you got into the blockchain real estate sector, and then move forward with what Lofty AI is.
Sure. So my personal background is pretty straightforward. I studied math and economics in undergraduate, at USC here in Los Angeles, and then I got a master's degree in financial engineering. The reason I kind of went that route was I always thought growing up I wanted to be a quant, and I would do prop trading at a big bank one day. I had the opportunity to go work at one of these banks in, basically on Wall Street, and turns out it's a lot less sexy than they make it seem in the movies. And believe it or not, a lot of people weren't aware of this, but after 2008, with the last financial recession, people kept complaining the government didn't do enough, but actually they did do a lot. There are a lot of new regulations put into place that essentially killed specific verticals of a investment bank's business, essentially, and prop trading being one of them. And so, I just kind of realized, hey, I don't know if this makes sense for me to have a career, in a different role at the bank for 20 to 30 years. This is what I wanted to do initially. So I decided to pivot into a different industry, and tech was always interesting to me. So I taught myself how to code, and I went to work at another startup here in Los Angeles where I met my co-founder, Max. And one day we were just in the office. I had always wanted to start my own company one day. And I was working on this pitch deck for this idea I had, and Max saw it. We basically started talking. Weirdly, no one was there that day. Like, everyone was at a conference. So we just spent 4 hours talking about this idea I had. And Max was really excited. And as crazy as it sounds, we both just kind of quit our jobs the next week and started a company together, which is pretty abnormal, right? If you think back about it. Now, that business idea is not what we're currently doing today at Lofty. For a lot of businesses and startups, you tend to have to pivot and try a couple of different business models before you find something that sticks. So we did that a few times, and ultimately, at the beginning of 2021, we came to our current business model. The idea for that was essentially, we realized that for any business to succeed, you have to actually solve a problem that a lot of people are facing, right? If you want to be a big business one day. And so one of the common problems we all had on the team was that we all wanted to invest in real estate, but there wasn't a good way to do it because real estate traditionally has a lot of barriers to entry. It's very expensive. The transactional process, traditionally speaking, is very time consuming, right? So if you're a busy professional, you don't have 60 days that deal with, sourcing properties and dealing with the middlemen and then ultimately closing on the property. It can be very draining. And then lastly, there's just always traditionally a lack of liquidity. So if you did have the funds, you did go through the process, things happen in life. And if you wanted to liquidate right away, you're probably going to lose a lot of money. Everyone's going to take a cut, all the realtors and all that. So not exactly the sort of most user-friendly investment, if you will. And that's when we looked at the blockchain and realized, interestingly, if you actually put the ownership of real estate directly on the blockchain, there's a lot of these sort of frictions and problems you can just kind of erode away naturally using the technology. And so that's when we had the aha moment of the team and decided to pivot into what Lofty does today, which is we turn houses into tokens so that people can freely trade them. And now, at $50 a token, there's no more capital cost in terms of barriers of entry. Anyone who's serious about wanting to invest in real estate directly can, right, for $50. The transactional process is a lot easier. You look at the documents, everything's kind of provided for you, standardized on this marketplace. You do your diligence, and that takes way less than 60 days. Essentially, you can spin up an account on Lofty in under 5 minutes and read some documents and get started building your portfolio. Then lastly, we have a secondary market where you can trade directly peer-to-peer with people. So the liquidity issue is also a lot better than what you would traditionally see in real estate, especially as co-owners with, another large group of people. Traditionally, you would have to have the entire ownership group kind of vote and agree and say like, look, we should sell the house. And then you have to list the property for sale. And again, that takes a long time, all of that, yada, yada. But now, being an individual owner, you can act independently. If you don't want to be a part of that DAO, essentially, and you don't want to be a part of that ownership group and sort of invest in that property, you can sell your portion, pro rata, and just sell it to someone else. You can exit, and the rest of the ownership that's happy with the property and happy managing it and dealing with the work, they can stay, right? So now you're collectively benefiting from owning an asset and managing it together, but you can also act independently without harming your other co-owners and without affecting them. So that's something that's really powerful that the blockchain brings. So ultimately, that's where I started, where we're currently with Lofty.
Fantastic. And a lot of people that watch my show know that I actually have a background in real estate myself as a realtor. And, using Lofty AI, I'm an avid user of it. Full disclosure, I think I'm in like 20 different properties or something of the sort. So I completely love the product. And as you mentioned, it really does just democratize that ability to invest in real estate. I mean, all of the information is there, all the financials are there, the secondary market is there, and with as little as $50, you're able to purchase real cash flowing assets, which is really revolutionary compared to as you mentioned, the traditional way of getting into real estate, which taking on loans, taking at least 60 days, sometimes even more. I know I had clients at the beginning of the year. It took about 6 months for us to find the property that they actually wanted to get into. So it really does change the game. And another thing that Lofty does that I really, really appreciate is it allows the token holders to vote on changes to the property, whether it be a new property manager or repairs that need to be done or what have you. And you mentioned it a little bit, but Lofty recently transitioned from member LLCs to DAO LLCs. Could you maybe fill us in a little bit on what the difference there is, and will there be any changes to how token holders use the product?
Yeah, so there will be very minimal changes from a user experience perspective, and that's completely intentional, right? We don't want people are used to doing it a certain way. We've designed the platform to work a certain way, so we don't want to throw that all out the window. Change can be scary for a lot of folks, especially in something like DAOs. Not everyone understands what they are, but ultimately the decision was, made. We put forward the vote because there's actually with DAOs two different concepts, and people kind of can't really separate the two, which is you can have a concept of a DAO, and then you can have an actual legal entity that's a DAO, right? There are two separate things. They can be the same, but in many cases they're used separately. And what I mean by that is you can quote unquote form a DAO with a group of people on a Discord, right? And you can manage certain things a certain way, like all the conducts, the way the asset is managed, or whatever the organization is trying to achieve and do can be managed like a DAO, right? And you can do that 100%, execute on that really well. But then if something happens with the government, right, whether, legal ownership, you have to own some, you have to ultimately go on and acquire an asset, or, in some cases, certain DAOs have done certain activities that certain regulators deem to be illegal. Like the CFTC currently has a lawsuit against a DAO. When they go after these entities, because there's no actual underlying legal entity, they often just kind of make up things, which is not good for the owners or the members of the DAO. So in that specific example, when it's just a group of people on Discord, I believe the government made the argument that it's basically a general partnership, right? And what that means is you as an individual have no liability protection. So if the government sues you, all of your personal assets are on the table, right? Of being a member of that DAO, if you voted in that DAO. And that can be really scary. And truthfully, that's how all the DAOs have been formed and managed in the past, because legally entity formations, things like that didn't really catch up to this concept of a DAO. But fairly recently, so when we started Lofty, there was no legal entity called a DAO, right? It was just conceptually you can manage things as a DAO. But halfway sort of through, like at the end of last year, I believe, the end of 2021 or towards the beginning of 2022, certain states, I think more will jump aboard, but Wyoming specifically and the state of Florida released a new type of legal entity called DAO LLCs. So now this is kind of the number two things. Now you have a legal entity that is intended to be run the same way that DAOs have been run in the past. But now there's an actual legal entity underneath that the governments recognize and offer certain protections that previously, without having that legal entity, you wouldn't get. And so DAO LLCs essentially offer you the same protection as an LLC, a member managed LLC. And what that means is it has liability protection. So if the DAO gets sued, right, your maximum exposure is the assets you own under that DAO, right? So if the DAO owns one house, worst case scenario, you guys all lose that house. So let's say you put in $500 as a part owner. Your maximum exposure is $500. They would not be able to come after your personal house. They would not be able to come after your car, and so forth. So you can see that provides a lot of benefits. And we believe, it finally makes sense that the concept of DAOs has a real world legal structure to sit on top of. And Lofty Properties have always been managed conceptually as a DAO anyway, right? And so now there's a legal structure to fit that style. So it just makes sense to couple them together. And now legally, conceptually, you have a DAO, but also legally you have a DAO that awards you certain protections, and which is great for the owners. And so it just made sense. So that's why we put forward the proposal, and we're really excited that members decided to vote to switch over to DAO LLCs, and this opens up a lot of possibilities for further decentralization down the line, improved governance and voting, and flexibility to how assets are handled and what you can do with them in the future. So there's a lot of possibilities. Not all of it is going to be built in now. We're exploring and will be exploring additional opportunities, but by just having them as DAOs, a lot of sort of doors have been opened, so to speak.
Yeah, that's absolutely fantastic, and I believe it was a resounding yes vote for the switch as well. I believe it was something about 85, maybe 86% of token holders voted for that DAO change, which is fantastic.
That's correct. Yeah, far more than the 60% bare minimum needed.
Yep, absolutely. And while we're on the topic of legislative problems and regulation and all the sort, I do want to ask about regulation in general. So there's a lot of projects that are trying to do something maybe a little similar to Lofty, maybe not exactly the same, but relatively similar. And some of them are going the route of only opening up to accredited investors, at least at first, with the ability to maybe open it up to everybody else down the line. Lofty is open to everybody, though. It's not just for accredited investors. An average person with $50 could invest in the platform. What sort of regulatory hurdles did Lofty have to jump through in order to get to that stage?
Yeah, 100%. That's a great question. So, let's talk about the vision, essentially, which is, everyone's talking about democratization of assets and investments in general. And it's true that that's something that's needed in society. We're at a point where, just by way of how our economy is designed and works today, you need to own assets to really benefit and have a comfortable retirement and get a lot of the same things that our grandparents used to be able to get. And the reason for that is just because wages are not rising with or without inflation at the same rates that assets do, right? And so people that don't own assets disproportionately get punished over a long period of time because assets value growth tends to compound. And so it's important to open up access to a lot of these assets, right? Otherwise, that's why you see the phenomenon. People always say, why do the rich get richer and the poor stay poor? Well, a lot of the rich people don't even do anything. They just own assets and they just sit there. And then, over generations, their wealth just keeps accumulating. That's exactly why. And so it's important for us to open up access and truly democratize asset ownership. And to do that, if you start off by offering it only to accredited investors or have high minimum buy-ins, to us, it just ethically, that just kind of didn't make sense. Like, well, what problem are you really solving? Accredited investors don't really have this issue that you think they have. Like, they don't really need this product. I have friends that are quite wealthy and from wealthy families. They're in their late 20s, early 30s. They own multiple properties already because their family just has the funds for them to go out and buy it. There are these accredited investors that a lot of these platforms are targeting. So just from a high level sort of vision perspective, it just doesn't make sense for us. So when we started the product, we always knew like we need to figure out a way, like how can we literally offer it to anyone, right? And that's ultimately how you solve the underlying problem. And so we looked and actually, it's kind of crazy and not exactly fun, but I read every no action letter from the SEC like since the 20s, I think, like as far back as it went. I think it took me 6 hours that day. We read, internally, all sorts of like regulatory rules and state rules and existing laws and even guidances, that haven't been sort of cemented into laws, but sort of regulators would put out articles and certain papers saying like, here's how we think we would treat something like this. And essentially, we probably don't have time to go into all the details, but essentially it breaks down into two main things at sort of the high level, which is investments, especially LLC interest, right? Like if you become an owner in an LLC or a DAO for that matter, isn't automatically considered a security, right? So there's a Securities Act, I believe there was one in 33 and 1933, and there was also another one that came out, amended some things in like 34, I believe. If you read both of those acts, it literally has like an entire page where it just lists everything that by default is considered a security. And you can't argue it in court. It just doesn't there's no argument to be made. If you do one of those things or you're selling one of those things, it's considered a security and it has to be regulated by a securities regulator. LLCs, right? Like ownership in an LLC is not one of those default things, which means there are exceptions. And so if you look at the rules, if you look at the guidance that the SEC and various state regulators have put out, basically, it comes down to how is that LLC managed, right? So now we go into one layer deeper. Is it actively being managed by its owners, or is there some sort of passive management where you give money to me and I say, JT, I'm going to take your money, I'm going to invest it on your behalf. You'll get quarterly dividends or you'll get an annual payout, but ultimately I buy whichever house I want to buy. I invest that money in whatever I want to buy. Maybe I share some of the upside carry with you, and I also charge you a management fee. That type of structure is, historically have been deemed essentially a security, and that's where the Howey case law kind of came out, which was, addressing that exact scenario. And so this is why you see a lot of Lofty's competitors opting to register as a securities offering, because the way their business model is designed, there's no way to argue around that. They just know by default they can't win that argument. And the reason is because they essentially operate like a private fund, right? Essentially, there's this group of people, and they're the managers, they're the owners of that fund. They're selling, limited partner shares, essentially, of their fund to you. So when you say like, oh, I'm investing in this house, that's actually not what's happening. What's happening is you're giving money to this group of people in their fund, and they are taking your money and investing in houses, properties, commercial real estate, whatever may be the case. They decide which assets to invest in. You don't have a choice. They decide when to sell the asset, the underlying asset. You don't have a choice, right? They can even dictate the payout periods of like, hey, I'll only want to pay you quarterly, or I want to pay you semi-annually or something like that. Really, you're completely a silent partner. And, if it's great and the investment team is great, like you can make a lot of money. A lot of wealthy people give money to funds and managers to manage their wealth. It can work quite well. But ultimately, that structure, there's just no way around securities law. And so that's why all of them either use exemptions by offering it to accredited investors, or they just register as a security going through something like crowdfunding or Regulation A+, things like that. Lofty is very different because we're a pure marketplace. So we never actually own the underlying real estate. Any properties you see that's listed has an actual seller that's independent of Lofty. And they're like, hey, I want to sell my house. But instead of selling to one person, our platform and technologies allows you to sell to multiple people, right? Which increases liquidity, demand, and things like that. When enough people want to become members of the DAO to essentially buy the property and the property is closed, it's again independent of Lofty. Lofty owns 0% in the underlying house, right? Like it goes directly from a third party and it's sold directly to another third party, which is a DAO group. Post the sale, Lofty also doesn't manage the properties. So you guys, and I'm sure you've seen the governance votes, but collectively the group, the owners that own these tokens, manage the properties, literally every aspect of it. We archive all this data, and again, moving on to DAOs and actually having a blockchain address where these voting decisions can actually be transparent. You can actually see which wallets voted for which decision. Is just further proof that we can use for the regulators. Like, we literally don't manage anything. And that's not just a token gesture. Like, literally operationally, we just never manage anything. If ownership groups can't come up with a decision, the vote just continuously, gets revoted, and people can discuss. Maybe you can change each other's mind, but no action will be taken unless the owners decide to take that action, right? And so then if you look at the case law for the Howey test, and you look at what's required to essentially be considered a security, one of the key aspects is you're deriving investment returns on the efforts of the third party. And the SEC has put out guidance that when they're talking about efforts, it has to be managerial efforts, because otherwise it's too broad, right? Like, if you send an investment memo and people give you money and you use Gmail, then you can say technically Google helped you raise money. Like, they would be liable for securities law violation or whatever like that. So obviously that doesn't make sense, and they don't want to do that. So it has to be managerial effort. And so then coming back to what I just described about how Lofty works, there's only two ways to make money in real estate, at least in these type of properties that's being sold on Lofty. Number one is rental income, right? And so what decides your rental income return? Not Lofty, because we don't decide the rent per month, right? Either the properties already have tenants paying an existing rent and you already know the amount before deciding to be an owner, so you're okay with it, or the property's empty and you, the ownership group, has hired a property manager, right? You're the ones paying them to go out and find you a tenant to pay a certain amount of rent per month. So Lofty has no say in that. Then in terms of management, if you have a tenant, let's say they a pipe burst and you guys vote not to fix it, or you guys just don't treat tenants well, right? They're unlikely to renew their lease. And maybe they even become delinquent. They're like, my landlord sucks. I'm not going to pay them until they fix this stuff for me. If that happens, your cash flow, your income directly suffers. So basically, how much money you make through renting out the property is 100% dependent on you guys as the owners, right? So Lofty has no impact on that. So then the second way of making money from real estate is asset price appreciation. And as much as I like to say Lofty is so powerful, we can move the real estate market, the truth is, especially for single family properties, it's just based on comps, right? And supply and demand on the secondary market. And that's really what's determining the price of these properties and the price of the token. So again, we don't influence that either. So really, you then go back to the case law of the Howey test. There is investment returns being made in a common enterprise, but it's not dependent on a third party and definitely not dependent on Lofty, right? And so what ends up happening is then we essentially have this specific business structure that is exempted from, or based on current laws and current guidance, should be exempted from being regulated by securities regulators, because they are not securities. And the idea is basically kind of like, hey, if you go out and you buy a house with your friend or your brother or your siblings or your family or your parents, right? There's multiple people, but nobody ever asks you, are you accredited investors? Like, do you understand what you're buying? And they're like, no, you have the money to go buy the house. You go buy the house, right? And best of luck to you. So basically, that's a long-winded sort of analysis of why we've opted to go this route, because we're not making it up. There is tangible and strong evidence that suggests the way we operate would basically mean that these are not securities, and that you don't need to be an accredited investor, which would satisfy our vision of, hey, we're really democratizing real estate investing because everyone can, invest in these properties. Now, obviously, regulations are fast changing in this space, so we don't know what the future will hold, but at least as it stands today with what's available out there, that's concrete laws or guidance, we're in the clear, right? And then we've spoken to lawyers about this, and people agree with us. So yeah, that's basically the case. We make to regulators if one of them reaches out. And we've also proactively reached out to regulators on our own. It's expensive, unfortunately. You have to hire lawyers to do that, and that can take a lot of time. But essentially, these are kind of the conversations we're having internally and with regulators.
Yeah, I'm sure it's quite a pain, to be honest. I mean, as you said, the regulations are not so clear. The guidance is not so clear as well, and it's ever changing. So who knows what the future holds? But it's great to hear. I do appreciate that that lengthy response, and I do think there's plenty of others that are out there in the ecosystem that appreciate it as well. So thank you for that. And I do want to ask, there's a lot of fractionalized real estate companies out there that do something similar, but still in the Web 2 world. So they don't use blockchain yet, and you can still invest in these properties, or maybe you're just investing in the member LLCs or whatever it might be. But I want to ask, why did Lofty decide to use blockchain? I mean, of course, we spoke about the use of governance and maybe even the secondary market. But what other benefits does blockchain provide Lofty?
Yeah, that's a great question. So there are two types of benefits, one more immediate and one more sort of future proofing, essentially for new possibilities that wouldn't exist without blockchain being integrated. So in terms of current benefits, it erodes a lot of the frictions away. So typically what those legacy companies do is it's all legal paperwork. You sign contracts to become a member of an entity to then invest in a property or a group of properties. And the company will send you contracts, you sign it, you send it back to them, they'll file it with the government. And when you want to sell, which in many cases you're not even allowed to because you just sign a contract that says you're not going to sell your ownership for 5 to 7 years, they don't have to allow you to liquidate. Or if you try to redeem early, you're usually hit with a penalty. And why are you hit with the penalty? Because it's expensive for them to deal with this paperwork. Like, let's say you put in $1,000, right? And you're in it for a week. You decide, this is not for me. A week later, you decide to sell. Just within a week alone, they had to deal with all this paperwork relating to you. You have to, prepare it. You have to sign it. They have to review it. They have to file it with the state. Probably before the filing even went through, they had to send you another paperwork for you to sign to say, nah, I changed my mind. I want to get out of this investment. And they have to file that with the state as an amendment. It's just incredibly complicated. And you need a big back office to handle all of that work. And people don't work for free. So your back office, you're going to have to pay them a salary, which ends up being just an expense on your balance sheet that eats into your margins. So as a business, what do? Well, they're not a nonprofit, so they're not going to eat that cost. They pass on the cost to the users. And so that's why for a lot of those platforms, they even have low minimums. It's not even related to accredited investors or not. They just realize that they don't want to deal with all that hassle for $500 or $1,000. It's okay to deal with that hassle if someone's putting in $100,000 or $1 million, right? Then the work is kind of worth it. They might even be willing to eat that cost because the returns for them are so high in that case. So that's why you have all these sort of frictions that isn't good on a user experience side. The minimums are too high. You can't liquidate, whenever you want. There's a lockup period. If you try to liquidate early, you get hit with the penalty, all that stuff. And so we realized you could do it that way. But again, based on the vision of democratizing real estate investment, you're not exactly doing that if at every step of the way there's expensive fees and you're just eating away at the profit margins of your users. And it's like, okay, we're allowing anyone to access real estate, but realistically, you're not going to make any money for like 50 years because of all these fees and things. So again, that's not what we're trying to accomplish here. So we realized that if we were to do this, we need to find a way to erode all of that. So either having terrible business unit economics ourselves and just eat the cost and hope investors are happy with that, or figure out something, from a technology standpoint that can help us genuinely erode away this friction so that we don't incur the cost. And as a result, then you don't incur the cost. And so what ends up happening is exactly blockchain solves for that. By having the ownership point to these tokens on the blockchain, we do away with essentially a lot of the legal paperwork. So when we're migrating over to DAOs, you'll see from now on, when you opt in and buy tokens in a property, you actually have signing with your wallet that basically saying like, I'm signing the operating agreement. I'm agreeing to be a member in the DAO. Here are my responsibilities. I read all the diligence documents and I'm happy with this investment. And that shows up, as a transaction on the blockchain. So, if governments ask or regulators ask, you can just say like, oh, view that address. You can see all these transactions, all the people opting in, which wallets opted in, and so forth. Anytime people need to know who owns what, right, the government can come ask for that information. Well, all our users are KYC'd. Your wallets are attached to your information. So we can say like, look, so-and-so owns, 20% of this property. So all that information is out there, which means, we don't have to have a back office. We don't have to update the government. It's all like basically public information. If they really want to know the details and they have, right process, they can issue a subpoena. They can, basically request it through a court if it's emergency, right? Someone's maybe doing something bad and they want to get their information. There's legal avenues for the government to do all of that. So that basically erodes away that friction. We don't have to maintain a back office for all these legal contract work, which means we don't have to incur that cost, which means we don't need to pass it on to our users. So immediately, that's why the minimums are so low, and we still make money from having such low minimums because we don't have the additional costs. If you spend $50 and you sell it tomorrow, literally Lofty doesn't lose anything, right? So the unit economics just kind of work out that way because of the blockchain. So those are the immediate benefits. And then for sort of future proofing, you can go into a bit more about secondary markets and potentially down the line having decentralized loans so people can leverage, kind of like having mortgages on chain to then buy their tokens. So instead of paying $1,000 out of pocket for $1,000 worth of tokens, you can pay $200, and maybe you're essentially taking on leverage and then borrowing the remaining $800 or 80% of that, which is very common in real estate. And that's actually where a lot of the compounding returns really start to, you should really start seeing that as the smart use of leverage in real estate. So all of those possibilities are only really feasible with a very robust and active secondary market, right? Because from a lender's perspective, you can come see and like say, hey, if someone were to borrow against their tokens, the tokens are just ownership in the property. Like in theory, you should be willing to accept that as the collateral. So if they don't pay, you just take their tokens, right? And that all sounds great on paper. Then the lenders say, well, what do I do with the tokens? Like, how do I get my money back? I don't want these property tokens. I don't want to keep the underlying house. Like, I want to sell it and recoup my money. So it's like, okay, that's why you kind of go back. Without a secondary market, where are they supposed to sell this? Like Lofty can't, if we had to buy back these things from the lenders, it would be, again, unit economics make no sense for us. We would need to have a huge amount of capital base just sitting there in case we needed to redeem these for the lender. So it just doesn't make sense. And so by having a liquid secondary market, where imagine it's like the stock market, people are willing to take Tesla shares as collateral. Why? Because there's a very transparent price. They know exactly how much money they would recoup today or tomorrow. And they know that if they executed an order for 1 million shares, it would go through, right? Pretty instantly, not immediately, but they'd be able to liquidate it in timely manner. So if they take your collateral, they can convert it back into cash, which is what lenders want. And so without having a secondary market that's very active and liquid, you can't realize that. And you can't have a secondary market that's very liquid without blockchain. Like imagine trying to trade shares in an LLC that's like a paper contract or a Reg A plus offering. You need all these additional layers like clearing houses. You need a licensed brokers and exchanges like that. And again, with anything that involves a lot of middlemen, you have friction and cost, right? Because nobody wants to do any work for free, so they're all going to charge money here and there, and so you end up with high transaction fees and various things that prevent liquidity in the secondary market. And then again, when you don't have liquidity, you probably don't have lenders that want to lend and against the collateral, which are these real estate tokens. So thinking very long term, without having the blockchain component, a lot of things that would be really good for users and consumers in this space would not be possible without high cost, right? So again, right, you can pretty much do anything, but if it costs a user so much money to do that activity, even if that activity is ultimately good for them, it kind of skews the calculation so that it's like, okay, now they can do it, great, but like Should they do it, right? And so that's kind of why we implemented blockchain, because it's necessary both short term and long term.
Absolutely, and I loved that answer, and you really gave me a lot to build off of from there as well. So I want to first ask about the secondary market that Lofty recently came out with. I believe maybe just only like 4 weeks ago or something like that. That the secondary
Just
market
a
came
little
out.
over a month ago. Yeah.
Uh, yeah, the secondary market, as you mentioned, it really does increase the liquidity, for these real estate tokens. I've tried it, I've used it to buy and sell tokens. I've sold tokens. It takes maybe just a couple days, where, in the traditional real estate world, it
Yeah.
might take 60 days to get it done. But
Exactly.
I do want to ask a little bit about that secondary market, though, because I've noticed that sometimes when you check the order book, there'll be an order, a buy order for, say, like $48 or something like that. And say you wanted instant liquidity, so you go to sell it for $48 or whatever. It doesn't grab that buy order right away. Sometimes still takes like a day to process that. So I'm curious, one, why does that happen? And then two, does Lofty have any plans to maybe increase the liquidity on the secondary market? I don't know if that would just come from more users as the product becomes more, as more users come to the product. I'd imagine liquidity would grow in and of itself. But I'll leave it there and then build off those questions.
Yeah, great questions. So the first question you kind of brought up of why sometimes the orders don't get matched instantaneously is because, again, we want to erode away intermediaries, right? So we want, when you make a trade, there is no quote unquote stock exchange. There is no quote unquote clearinghouse. There's no brokers. Like, that entire stack in the legacy financial system is just gone. You're directly trading with someone else. That's it. Just you're the buyer, someone's the seller. You're the seller, someone's the buyer. Lofty is not even acting as an intermediary, right? And the only way to utilize that and make that a reality is by having smart contract based trading system, which we have. The issue with that is smart contracts by nature is a sort of a blockchain innovation, right? It can only operate with digital assets, which means that you have to use cryptocurrencies currently. You can use stable coins, but basically you can program it to use any digital currency, but it has to be digital based. But what that means is digital currencies often fluctuate in value, right? If you're putting in an offer for $50, you're not using US dollars backed by the US government. You're using algos, you're using USDC, which is a stable coin. It's backed by a private corporation, but that backing, one-to-one backing, is only true when you take the USDC and you give it to that private corporation. Then they'll back it one-to-one and give you the exact dollar amount. If you're trading or you're buying USDC on an exchange, you can see the value. It's very close to one, but it fluctuates, like 9987, and then it becomes like 9986, right? And so those tiny little digits, in the decimals, make a difference, because smart contracts is code. So code is very exact, right? And we don't want people to have essentially slippage where, like, hey, you're like, I want to buy for $50, but your trade ended up costing you $51, or some amount that isn't what you initially wanted. We want it to be exact. So that's how the smart contracts are coded. But what that means is the moment you put in a buy order, if your initial order you put in at the exact dollar amount, it will convert to the exact equivalent amount of cryptocurrency. But the moment you put in that order, the market rate just fluctuated a little bit. And so now you thought you put in an order for 50, which should match with another order that's $50. But in reality, your order is at 49.9998, which is very close to 50, but isn't actually 50. And we don't want to give the other person, 49.99. We want to give them, make sure the trade, they want to sell it for 50, they should get exactly 50. So that problem will be solved when we're building, which we're building right now as our next big feature, what we call bridging fiat with smart contracts, which actually is a very complicated thing. That the annoying thing about building in blockchain is that it's so new in this space, and I think too many companies and businesses have focused on only catering to crypto native people. So there's a lot of tooling that's important for real world use cases that haven't been built yet. I wish there were some company that just had these things, the exact specification we need, and we just pay them a monthly subscription, use an API, and just integrate them into Lofty. It would be a lot easier for our tech team. But for a lot of these features, like this bridging aspect, we have to build it internally, right? And so what that means is we'll soon allow you to use a credit card or ACH you can make an order on the secondary market with fiat, right? Then when you put in $50, you're actually paying with $50. But in the background, there's some complicated conversions going on where your order is converted into USDC, and then that's what's used to transact with the smart contract, which then allows your transaction to occur. But from a user perspective, you don't need to know any of that. It just kind of happens in the background. You put in $50, you buy something for $50, right? And so that step will come soon, right? Probably before the end of the year. We're pretty confident on that. So when that happens, the issue you just brought up would no longer exist as long as you're using the fiat rails, like you're actually paying with ACH or credit card. If you're paying with cryptocurrency, unfortunately, that's always going to be the case, which is why we recommend people use stablecoin, because the price fluctuations aren't as severe. And also, if you really want a transaction, like you want to buy a token really badly, you think it's a great deal, you're like, let me swoop this up for someone else. You can literally tweak it so that your order is 1 cent over their asking, or 3 cents, or whatever margin that you're personally comfortable with. And I guarantee you, if you have that additional margin, then you put in an order, it'll get matched pretty much instantly. Otherwise, it can take a few days while the price fluctuates back up so that, your bid is now the exact amount of the ask, and then it transacts. So that's why you kind of see that phenomenon. The second issue of just adding more liquidity, you're right, is a function of two variables. One is just having more people use the secondary market. So as we get more users, which organically we get every single day, and more people start getting comfortable and interacting and kind of trading real estate assets this way, because it wasn't possible before. So there's a psychological barrier as well. It's like, what do you mean I buy a house today and I sell the house tomorrow? Like I can, it just didn't exist. So it bewilders a lot of people. And so it takes some time for them to adapt. But the more usage it gets, the more liquidity will be there. Then the next thing we're going to roll out next year is automated market maker. And what that does is essentially, it's how the stock market works. There's a centralized entity called a market maker. And what they're doing is they're constantly buying and selling the same stock, like repeatedly. Like they buy it at a little bit lower and then they sell it for a little bit higher. And that's how they make money, right, for this activity. But what that means is if you put in an order at a market price, it'll basically go through immediately. And that's what most people do in the stock market. They just buy it at the market price. And that's why you see so much liquidity, because there's someone constantly buying and selling, right? But typically, traditionally in finance, you needed this centralized entity, which is a big bank, a hedge fund, so some large player with a lot of dry powder. But with blockchain and DeFi, you now have a thing where you can have an automated one, which is just an algorithm that does the exact same work. And all the algorithm needs is a pool of liquidity, basically money that it can use to facilitate these transactions, right? And that pool of money, the way it's been handled before and how we plan on handling it, because we want this to kind of be, decentralized and open source. We don't want to be the business entity that's doing the work, is the algorithm will do all the work and the liquidity pool will be a public liquidity pool. So soon when we roll out this feature, you can stake various cryptocurrencies and even US dollars, right? Because we already built a bridge to allow you to, interface with a lot of the crypto rails using US dollars, but you can contribute liquidity to this pool. And in exchange, you would get yield out of it, right? And why does that make sense? And how are you able to get this yield? The way a market maker works is it's buying the tokens at a lower price and then reselling them at a later date, later time for a higher price. So it makes a small spread for every trade, right? It makes a little bit of a profit. Now, traditionally, if you are a centralized market maker, you would keep all that profit yourself. But being a decentralized one where, there's a liquidity pool and anyone can contribute, that's where the yield comes from. Basically, the algorithm is sharing the profit with people who provide liquidity. And the yield will fluctuate. So if a token or a property is extremely liquid, the spread between the bid and ask, which is what the algorithm buys the token for and resells for, will be very minuscule, right? Like maybe pennies, right? Something like that. And in that case, the yield will be very low, which means there's too much liquidity actually in the pool for that property. And what that will do is people will look at that and say, I'm not making a lot of money staking my funds here. Let me pull my funds out and I can use it somewhere else, right? And you'll actually see liquidity being pulled back. at which point when there's lower liquidity, if there's not enough liquidity, right? So when the pool is first spun up, the margin between your bid and ask is going to be very high. So for example, some of these properties you see in the order book, the closest bid is like $44, and then the closest ask is like $65. So do you see the spread? You like, on one trade you can make like $15, which was huge percentage wise. And so when this pool doesn't have enough liquidity, the yield is going to be astronomical. So it actually attracts a lot of people like, whoa, I can stake in this pool and receive 20% returns, right? In terms of yield, like, of course I'm going to put my money in there. And so there's this self-correcting mechanism. And when that happens, the secondary market on Lofty will be, from a user experience, almost indistinguishable from the stock market. Your trade will pretty much go through instantly, provided by open source liquidity essentially. So you can both be a token owner in properties and also be a liquidity provider. But we also even plan on opening it up to just the general crypto community. So like you could theoretically want nothing to do with properties and tokenized real estate, but you can just be a member and stake various currencies in this liquidity pool. Like in fact, we may or may not even require KYC for it, right? Because technically you're not owning property, you're just staking, and it's going to be a sort of DeFi mechanism. So that's essentially the feature we're going to roll out, in addition to having higher usage that will really, you'll see a big jump in liquidity. But the way we release features at Lofty is to not waste time building out the complete version, because chances are no matter what you roll out, there will be improvements and things you get wrong that your users like or don't like. And so you have to tweak them. And it's very costly and expensive to just roll out something you think will work, and then it turns out it doesn't work. You wasted all this time and you have to rebuild, right? What we do is, if there's even an incremental improvement that can be made, we'll just release the feature, even though it's not ultimately where we want it to be. And then we'll just release the additional benefits as future updates. So the exchange is a great example of this. Some of the users complain, it's like, oh, well, liquidity is not that great. Like, that's technically true, but what was your alternative? Like, these are real estate assets you're investing, which is, as you mentioned, traditionally in real estate, buying and selling a property within 3 or 4 days was not really possible, right? Like it takes you months to liquidate your house. So we went from potentially 60 days down to 3 or 4 days, which is an incremental improvement, right? And that's the experience we release to our users. And then next, we're going to release additional things that will take that down to a day, maybe down to seconds, right? And ultimately, that's how we build features at Lofty.
That's amazing, honestly. I really, really, really love that feature. Is there a timeline for the AMM feature on that?
AMM AMM has two things. So typically you want to seed the AMM with some liquidity. Like, you don't want to launch and the pool has $0. Right. So you want to seed it with some sort of liquidity. And, again, being smart, business decision, we don't want to be the one to have to contribute liquidity. So there's two components to it. There's a technical side, which is building out the infrastructure and everything that's needed. We'll be able to roll that out probably first quarter of next year, so 2023. But in terms of finding a partner that's willing to seed it, we're talking to hedge fund, traditional legacy finance players. Lofty is a venture funded startup. So we're also talking to our investors as well, but you need to basically cobble together liquidity to seed it initially. And, we even plan on having discussions with the Algorand Foundation itself. Maybe they'd be willing to provide some liquidity. So there's two parts I need to take care of. What's relatively certain is a tech part, because that's something we can control. As far as the seeding of the liquidity, it just depends. Maybe it happens a lot easier than we thought, and someone just says yes the first week of January in 2023, or it takes longer to negotiate things and so forth. So unfortunately, I can't provide an exact date on that second piece.
Yeah, it makes sense to me. This is a perfect segue into a question that I wanted to ask when you were bringing up DeFi loans and things of this sort, because there's a lot of conversation. I've had interviews with the people at Folks Finance, at AlgoFi. I talk to the community a lot, and there's a lot of interest in getting Lofty AI real estate tokens on these lending platforms. Of course, I mentioned Folks Finance and AlgoFi, but I'm sure more will pop up over the years. And it seems that there's two main issues with, putting these tokens on a decentralized lending platform. And the main one being a lack of liquidity, which we just talked about. And the second one being that if you have community liquidators that can essentially liquidate these positions, you might end up in a situation where whoever's receiving these tokens aren't KYC'd at that point. And I'm not sure if that would actually be an issue down the line when it comes to regulators. So I want to get your opinion on what do you think the future is for using these tokens as collateral on decentralized markets, and how far into the future do you think we are until we see that happen?
Yeah, so I would say originally the ball was kind of in our court and Lofty's court. There were a lot of things that didn't exist. We had to build out to make this even remotely possible. You mentioned the KYC part, and that was a big blocker, right? Which is, you KYC through Lofty. If we let you then stake these tokens elsewhere and borrow funds using the tokens as collateral, and you don't pay back or you get liquidated, whoever received the tokens may not be KYC, and that could be a problem for us, right? The government never blames you guys; they always blame us, even though we're like, we didn't force the person to use this as collateral, because again, the threat is always like, the government always say, well, what if the person on the receiving end was a terrorist or like launders money or something like that, right? So that KYC piece was really important. But what we ended up building for the secondary market is, you might have noticed you actually have an NFT. We call it the verification NFT. So anyone who is registered to trade on the secondary market with Lofty, which is automated now, basically, if you create a Lofty account, connect a wallet, you basically get certified to trade on the secondary market. You get sent an NFT that we as an entity can claw back, right? So basically, as long as you meet the KYC criteria, which people don't realize, but it's ongoing. So it doesn't just happen at the beginning when you create an account, but every month, your information is being checked against a government database, right? So at any point, if a good actor becomes a bad actor, that would get flagged as well. And in that situation, we would claw back the NFT and say, like, look, you aren't qualified. You shouldn't be allowed to trade on the market anymore. But by having these NFTs, anyone can interface with them, right? So folks find out like all these other providers in the ecosystem can now check wallets and see, do you have the Lofty verification NFT? So now that step is a possibility where the ball is in their court now. So in theory, if they want to build this out, they already can, which is they can create liquidity pools where people can stake their Lofty tokens and use that as collateral to borrow whatever currency that's available on these DeFi platforms. And as long as you make sure that, let's say the person using the collateral gets liquidated, the tokens are claimed by someone who's also verified by Lofty by having that NFT, then that transaction is fully legal. It can go through. We don't care about it. It works for us. There's very minimal work we need to tweak in our platform's code to accommodate that. So yeah, I would say it's already possible technologically speaking today. It's just a matter of, do these other platforms and providers want to go that route? And if they do, I would invite them to come chat with us. And also just to say like, hey, you can ping our API for the price action on the secondary market of what the trades are, what the orders are, and you can ping the blockchain because again, they're smart contracts, so the orders are open on the blockchain. You can ping that to get price data, so that part is fixed, and then the NFT verification solves the KYC identity issue. So both of those pieces being in place, in theory, you should be already able to spin up these pools where you can use Lofty tokens as collaterals.
Fantastic. And I know we're a little bit past our time here, so I'll wrap up with just two really easy questions.
Sure.
So for first-time users, whether it be investors or even somebody that might want to list their own property through Lofty AI, how easy is it to get going?
As a buyer, it's incredibly easy because the platform is designed for buyers, and so literally takes you under 5 minutes. You set up, go through KYC. It used to be the case you needed your own algo wallet, right? You have to go out and download that. But for a lot of people who are new to Web3, that can be very intimidating. And so now for every account that's created on Lofty, there's an automated multi-sig wallet. So it is your own wallet with its own unique address. You can even use it to hold other assets on Algorand, but Algorand wallet spun up for you, right? That you can, once you learn how to manage things, you can spin down and use yourself, or you can just keep it within your Lofty account. But so that barrier is removed. So now you don't even need to know about wallets. You can just create an account and get started right away. So in literally under 5 minutes, you are able to go from not having an account to having an account and buying your first token, right? For new properties, we can use ACH, credit card, which, it's very easy. You don't even need to go out and buy cryptocurrency first to transact. So for buyers, it's incredibly easy and I would say not intimidating at all. For sellers, if you want to sell your own property, it's a bit more complicated. We plan on, again, making it super simple as well, mostly an automated way down the line. But right now, you would basically email our acquisitions team. So that's literally the email address, acquisitions@lofty.ai. And you would just say, hi, I have a property. Here's the address. Here's some photos. And someone on our team will reach out to basically ask you some questions to see if it's a good fit for our marketplace, and also tell you that there's requirements like, hey, you're gonna have to order an inspection report, appraisal reports. If you don't want to do any of that, then I'm sorry, you can't list the property, right? So they'll kind of take you through the steps. So for sellers, it's a bit more difficult, but I would also say your benefit is bigger. Like you get to liquidate your entire house, presumably for a shorter period of time than it takes on the active market, like on MLS, and you get an all cash offer, which is really valuable for people. So it's guaranteed to close. So your payoff is also big for a little bit of emailing back and forth.
That's fantastic. Fantastic. And last really easy question. Algorand's having their annual Decipher conference in Dubai this year. Is there any chance Lofty or any representatives of Lofty are going to be out there?
Yes, actually, I'll personally be there. I believe I'm speaking on a panel as well, but I don't think they've updated the speaker page yet.
Fantastic. Yeah, I think they just came out with like a more detailed agenda, but I haven't checked it out personally. Myself and my two co-hosts over at the Next Block will be there as well. So hopefully we run into each other and meet in real life.
Yeah, definitely. It'd be great to meet in person.
Absolutely. Absolutely. So this has been a fantastic conversation. I still honestly have a bunch of questions. So if you're willing to come back on in the future, I'd love to have another conversation. But otherwise, I really appreciate you taking the time out of your day to join us. And, just take a minute to let my audience know where they can go to learn more about Lofty or yourself or whatever you have going on.
Sure. I have a Twitter handle. I'm not super active, but if you want to reach out to me personally through social media, that's probably the best way to do it. It's at PMDBT, just a string of random letters. I've kind of figured out as a teenager and realized as long as I use that, I'm always guaranteed an account on, whether it's a video game or social media, because no one ever uses that combination of letters. So that's my account. And for Lofty itself, it's very simple. You go to www.lofty.ai. We have blog posts that helps kind of educate you on real estate investing and how our platform works. You can right away browse the properties, look at the documentation associated. You don't need a Lofty account to do that. And we have a great support team, Luis. So reach out and chat. There's a real person at the end of that. On the opposite side of that little chat box. So if you have any questions, feel free to reach out to us that way as well.
Awesome. Well, I appreciate you taking the time out of your day to join us on the show. And until next time, hopefully we see each other in Dubai.
Yeah, likewise. And again, happy to be here. And thank you for inviting me.
Awesome. Take care. All right. That was my conversation with Jerry Chu of Lofty AI. If you enjoyed the discussion, smash that thumbs up button and consider subscribing to the channel. Now, I'm not sponsored by them, but if you enjoyed the discussion and are interested in Lofty AI, check out the video description for a link to get $25 towards your next real estate investment using the Lofty AI platform and my link down below. Typically, the minimum investment is about $50, so this link will get you halfway there to your first investment in real estate. So check out that link, get that $25, like and subscribe to the channel, ping that notification bell so you don't miss any future conversations with any of our upcoming fantastic guests, as well as our upcoming trip to Dubai. You're not going to want to miss any of that coverage. Like and subscribe, hit that notification bell, and of course, we'll catch you in the next one. Thank you very much.